Vice Chairman and CEO of HDFC, Ms. Kakunath Nagte, President of Country Head India, Bank of America, Mr. N. Venkatraman, CII National Committee on MNC and CEO Deloitte India. Ladies and gentlemen, a very warm welcome to the 15th CII Corporate Governance Summit. CII Corporate Governance Summits were always held in person in Mumbai. However, due to pandemic and to keep continuity going, we had last year and now this year the summit is on virtual mode. I'm told we have over 1,000 participants joining the summit today, and this only endorses the significance and importance of issues like corporate governance, which corporates need to practice in true spirit and letter. Mr. Sinha, thank you very much for joining our session today. As chairperson of SEBI, it is notably that major reforms took place during your tenure under your leadership, including streamlining of SEBI LODR regulations and reworking various legislations, including insider trading, listing and delisting norms. And a lot of other elements also you helped to smoothen out during your various other tenures as Chairman and Managing Director of UTI and Chairman of Mutual Funds Association of India and Joint Secretary, Ministry of Finance. Mr. Sinha has received several prestigious awards and recognition for his contribution to smooth running of capital markets and has supported the industry immensely in terms of acknowledging and addressing several issues. Thank you once again for taking your time, and we look forward to your address. A very warm welcome to Mr. K.K. Mistry, Vice Chairman and CEO of HDFC Limited. Mr. Mistry is also Chairman of CII National Council on Corporate Governance, and under his leadership, CII has established a niche place in policy and advocacy in the areas pertaining to corporate governance. Council is constantly working on issues and making suggestions and recommendations on a variety of issues to enhance standards of corporate governance in India. Under the chairmanship of Mr. K.K. Mistry over the years, Council has picked key issues concerning the industry, including independent director issues, sustainability, ESG, BRSR compliance, and cybersecurity issues were all taken up. I would like to take this opportunity to express our thanks and our appreciation to Mr. Mistry for taking time for supporting this important initiative. I also want to welcome two of my colleagues from CII, Kaku Nagte, President and Country Head of Bank of America, and Venkatraman, member of CII Committee on MNC and CEO Deloitte, for their immense work in this very area of corporate governance. The subject of corporate governance finds prominence in CII's agenda, and CII has all along been a proponent of corporate governance in India, from the Voluntary Code of Corporate Governance, which was released as early as in 1998, to CII's guidelines on integrity and transparency in governance and responsible code of conduct in 2020. CII continues to establish its position as a front runner for the industry, taking the lead in recommending corporate governance practices for its member companies in true letter and spirit. In 2020, CII Corporate Governance Guidelines enumerated 15 recommendations on topical issues covering organization culture, values, including its commitment to integrity, fairness, honesty, transparency, and ethical conduct. As a responsible corporate citizens, the guidelines suggest that an organization will integrate ESG principles in the business. In fact, ESG is an area of work which CII is focusing in a big way. Sustainability and ESG have emerged as key board agenda issues, and markets are giving greater weightage to companies that provide sustained value creation. Companies have a larger footprint, are improving ESG disclosure globally. Investors pay a lot of attention to this and focus on companies which fare better on sustainability index. ESG is one of the key governance differentiators in the COVID world and is more or less mainstreamed into corporate governance. There is a growing trend of ESG diligence in market transactions, including mergers and acquisitions, capital raising, strategic transactions. It's a key tool for ensuring stakeholder value. The pandemic has reinforced the importance of strong corporate governance framework. With the evolution of role of corporate and change in ideologies, there is now much more focus on this very issue, including on the areas of cybersecurity and risk and crisis management. This is also reflected in the change in investor focus from profitability to other important issues like long-term sustainability, disclosures, and compliance. We also see the necessity to embrace technology. Boards now consider IT and cybersecurity as a business risk. Board composition, director appointment process, board effectiveness have all drawn focus during the last few years. The theme for today's inaugural session is Governance Principles for Business Resilience and Continuity. The onslaught of uniquely challenging health pandemic and the current geopolitical environment have impacted society, economic landscape, and have taken corporate governance back to the drawing board. Globally, pandemic has challenged governance and ethics at its very core to focus further on the very theme of resilience. Against this backdrop, CII Corporate Summit will focus on 4 broad themes during technical sessions planned over next 2 days: commitment to ESG and corporate citizenship, enhanced disclosures, that is compliance and transparency, board diversity, succession planning, and talent management. Lastly, board decision making, including technology and digital collaboration. We have many distinguished speakers, technical experts who would further deliberate on these important issues. I would again, with these words, thank you all for your kind presence and welcome you to CII's 15th Corporate Governance Summit. Thank you all for joining us today. At this point, I would like to invite Mr. K.K. Mistry, Chairman, CII National Council of Corporate Governance, and Vice Chairman and CEO HDFC Limited for his introductory remarks. Over to you, sir, Mr. K.K. Mistry.
Thank you, Mr. Mukundan. Mr. UK Sinha, Mr. Mukundan, Mr. Venkatraman, Ms. Kaku Nakate, members of the CII Governance Council, friends, ladies and gentlemen. A very good morning to all of you. On behalf of the National Council of Corporate Governance of CII, I would like to welcome all of you to the 15th Corporate Governance Summit. At the outset, I would like to personally thank each and every CII Council member for their contribution and their valuable time and inputs during the various meetings we've had during the year. The members have brought in their immense wealth of experience and knowledge to make a positive contribution to the corporate governance landscape in India. To give you a very brief recap of the developments during the year, the Council formed 4 subgroups to examine in depth some of the topical corporate governance trends that are influencing boardroom discussions in India. The first subgroup was formed to identify key challenges on regulatory issues and to engage with regulators for policy intervention. The second subgroup was formed in order to develop a framework to help integrate ESG practices of organizations with UN Sustainable Development Goals and to compile information on ESG so as to provide insights to boards on how they could incorporate sustainability as part of their strategy. The third subgroup was formed to examine issues related to boards with a particular focus on independent directors, board evaluation, and board training. And the fourth subgroup was formed with the objective of compiling best practices on cybersecurity so that boards can address cybersecurity threats and data protection mitigation measures. Council members provided some very valuable suggestions on a variety of matters to improve the standards of governance. Based on these recommendations, CII submitted various representations to appropriate authorities. I would also like to thank the Ministry of Corporate Affairs and SEBI for being extremely proactive and for implementing corporate governance policies with an aim to enhance fairness and transparency, strengthen the role of independent directors, promote diversity, improve disclosure standards, and protect shareholder interests. Let me now come to the topic which I am going to address today, which is the role of boards during unprecedented times. The board acts as the stewardship body of the company, both guiding and supporting management in taking decisions, particularly during difficult times, and ensuring that the company emerges from the crisis stronger and even more resilient. A crucial and critical black swan event like COVID can enable the transformation of the organization for the better. For many organizations, there was a lot to learn from the COVID crisis so that they could emerge from it stronger and as a more resilient organization. When the crisis started, very few boards had a ready answer about how to manage such a catastrophic event. However, what emerged was that organizations that had followed robust corporate governance practices with the highest ethical standards were able to weather the crisis very effectively. The quality of governance has been a differentiator during this crisis and will remain so in a post-COVID world. During the pandemic, all organizations and their boards were forced to introduce various new measures to sustain their business. Organizations had to relook at the risks facing their business and also grapple with corporate governance trends that became prominent during the crisis. The current scenario of COVID variants, supply chain disruptions, geopolitical tensions, and inflationary pressure suggests that 2022 will continue to challenge corporate boards as they and their management teams continue to navigate a somewhat demanding and difficult business environment. Boards have to play a special role in helping the organization to return to the new normal by working with management on identifying weaknesses and addressing areas where improvement is possible. I will briefly touch upon 4 themes that are likely to gain increasing traction for boards this year. The first theme is on risk management. The pandemic has confirmed that unexpected disasters can indeed occur. Having come through these past 2 years, boards and senior leaders need to assess if their organization's crisis management plans were up to the challenges they faced. Going forward, organizations may need to develop a readjusted risk management framework. Risk management is about preparing for an uncertain future. One of the current uncertainties is assessing how many of the various challenges that boards have experienced during the past year will prove to be permanent. After the pandemic, 3 considerations for the boards will be cybersecurity, data protection, and legal compliances. The crisis has shown that the need for long-term strategic thinking can never be overemphasized. Boards that have a long-term view have always been able to help their organizations emerge stronger after every crisis. During the pandemic, boards without a holistic view of forward-looking fiscal scenarios were taken by surprise when the tide turned so dramatically. The age-old saying that the best risk management framework is one that fortifies the balance sheet in good times so as to create sufficient ammunition to tackle a downturn held true during the pandemic. The second theme I would like to talk about is on shareholder activism. Investors are becoming more assertive and feel empowered to demand action and disclosure on a growing number of topics. Failure to meet these demands is more likely than ever to result in activists voting against companies and individual directors at shareholder meetings. Globally, we are witnessing a spurt of high-profile instances where proxy advisors and investors are deciding the course for the company. For instance, Trian Partners and other shareholders successfully rejected Unilever's $68 billion bid for Glaxo's consumer healthcare business. The most prominent corporate governance case of 2021 was the proxy contest at ExxonMobil. The issues included board composition, governance, sustainability, and shareholder engagement practices. Interestingly, a first-time activist managed to win 3 seats on the board of ExxonMobil despite owning only 0.02% stake in the company. Elsewhere, for other organizations, there were various demands from proxy advisors. The common demands revolved around the appointment of directors, reconstitution of the board, CEO pay packages, and exploring strategic alternatives. Going forward, boards will need to actively understand the concerns of key stakeholders with an emphasis on listening and learning about viewpoints of the shareholders. Boards also need to stay informed of the disclosure requirements of proxy advisors. They also need to identify any vulnerability in the strategic or governance practices of the company. Sharp changes in stock ownership also need to be monitored. The third theme I would like to talk about is ESG. Mukundan referred to it. An area of growing interest for activists is on ESG-related issues. In the West, environmental activists won a series of victories against leading companies in 2021. They forced companies to adopt sustainable business practices and win board seats. Over the past 2 years, some of the largest asset managers have vowed to champion the ESG cause. They voted in favor of many environmental and social shareholder resolutions, and they are holding board members responsible for reporting ESG risk. As Larry Fink wrote in BlackRock's 2022 letter to the CEOs, he said, and I'm quoting him, most stakeholders now expect companies to play an even more demanding role in decarbonizing the global economy. SEC has very recently voted for mandatory climate risk reporting by public companies in the US. Many boards have been working proactively for years to integrate ESG criteria into their business and annual financial reports. We have to remember that ESG goalposts keep shifting for investors. Since the war, carbon emissions are suddenly less of a concern, while energy price-induced poverty is more of a worry. Boards need to gauge the public mood, and those with international presence need to anticipate shifts in government policies, such as new regulations and sanctions, which could have a huge impact on the business. In India, corporations are beginning to publish ESG reports. In fact, some Indian companies have published their first business responsibility and sustainability report in financial year 2021 on a voluntary basis, even though this was made mandatory by SEBI only from the current year. As the expectations from the boards about what they are doing for ESG continues to develop, directors should work with management to identify the material ESG risks and opportunities faced by the company and try to integrate these considerations into the organization's strategic and operational decision making. Directors and the management should engage with investors to understand the perspectives and priorities with regard to ESG. Conversely, international investors too need to engage with companies directly rather than just rely on third-party reports or ratings, which may not always reflect nuances at the country level or issues that are specific to a company. I do believe that from this year, we will see greater shareholder activism on ESG issues in India, with a special focus on how organizations are addressing climate change. This will be of particular relevance to companies with large foreign shareholding. Boards will need to focus in a bigger way on ESG issues and address the following two questions. First, should the board add ESG expertise and establish a dedicated ESG committee? And two, to what extent should executive compensation be aligned with ESG performance? The fourth and last theme that I would like to speak about is on board effectiveness. Enhanced board effectiveness practices are becoming the norm as investors realize that board composition, refreshment, and evaluation practices result in improved corporate performance and decreased risk exposure. Boards will need to demonstrate their commitment to proper evaluation and succession planning. According to Institutional Shareholder Services, board refreshment is best achieved through robust individual director evaluations to ascertain the evolving needs of the board and to bring in fresh perspectives and skills. Board committees and individual directors, evaluation of them are a critical tool for maximizing board effectiveness. Boards need to ensure that each director in the boardroom is the right fit. To be effective, a board's assessment process needs to be honest and thorough. More importantly, it needs to lead to action or change. In today's environment, the standards of knowledge required of directors across all topics has increased. Directors are expected to contribute to the discussion on all aspects of the agenda and not merely on their own area of expertise. To meet investor expectations and improve board effectiveness, directors need ongoing insight sessions and regular training programs that keep them abreast of rapidly evolving topics such as cybersecurity and climate change. This will help directors maintain the skills and knowledge needed to effectively execute their responsibilities. I would like to emphasize that one of the main challenges for board effectiveness in the current environment is the ongoing struggle to stay focused on strategy and not get bogged down with administrative matters. Issues such as adhering to fast-changing regulations, diversity, CSR, ESG, and black swan events such as COVID-19 and the Russia-Ukraine war continue to keep getting added to the agenda. In a nutshell, boards have a Herculean task. Board meetings thus need to be designed to maximize meaningful strategic discussion, but with an underlying overtone that ensures that appropriate risk management practices are adhered to. In many instances, both board and committee agendas are packed with a variety of matters. Some of these are routine in nature, but time-consuming. Therefore, deciding how to allocate time is difficult. In an ideal situation, the board agenda must be broken up into two distinct parts. First is routine matters, and the second is issues where policy decisions are required. By doing so, the board meeting can focus on discussing and debating on key issues. Let me conclude by saying that the bar continues to rise for Indian boards. India Inc. is proceeding on the right path in establishing best practices in governance. Commitment to good governance leads to a distinctive competitive advantage. It enhances reputation and creates long-term sustainability. Organizations need to focus on prudence and long-term growth, irrespective of economic cycles. I hope that you find this summit useful. We have carefully selected those corporate governance topics for discussion that we feel are key issues affecting India. I look forward to a constructive deliberation and dialogue on how we can continue to improve our governance standards. I am confident that corporate governance practices in India will keep improving, which will enable easier access to capital from global markets and greater transparency. Thank you very much.
Thank you, Mr. Mistry, for those words. I think your key point about stewardship of company work through high quality of governance is critical. You've highlighted 4 pillars of doing this in the current context: risk management, so followed up with a proper scenario planning, crisis management. Stakeholder activism is going to increase, shareholder activism is going to increase, and you said stakeholder engagement is extremely critical. You brought out the importance of ESG, especially you also highlighted to how do we sort of make it central to the way the company is run and its strategy, including aligning executive compensation. And lastly, the most important critical piece you highlighted is board effectiveness and asking the boards to focus on strategy and not on administrative issues. But I also have given a way the boards can structure this by focusing more on strategic issues, and routine matters are kept separate. I think all in all, a very good guidebook and a bookend for companies to make the change and start the journey towards excellence in corporate governance. It's a journey, as you mentioned, and it's a never-ending task to continue to keep moving forward as the bar keeps getting raised for Indian corporations. Thank you for those words. At this point, I'd like to invite Ms. Kaku Nakte, President and Country Head, India, Bank of America, to kindly address us. Over to you, Kaku.
Thank you. Good morning, Mr. UK Sinha, Mr. Keki Mistry, Mr. Mukundan, and Mr. Venkatraman. I would also like to extend a warm welcome to each one of you who have joined us today to ponder over how organizations can safeguard against various business contingencies. My sincere gratitude to CII for inviting me to connect with leaders across the business spectrum. Today, I have been asked to talk on how Bank of America has really prepared for business continuity and business resilience. Of course, as Keki Mistry mentioned, ESG is core to Bank of America. We have been always working with a mission that you need to earn profits, but it has to have a purpose. ESG is a part of every KPI of every individual in Bank of America and has no longer remained at the top. Out of this, one of the biggest topics that we are today talking about is how do we really maintain sustainability and how are we prepared to tackle the next emergency, which was realized that most corporates as well as banks had to really get going, and the emergency impact was not properly understood until COVID really happened. And most of us had really underscored this event. So firms which were well prepared and had a comprehensive business resilience and continuity plan better handled the COVID crisis and were up and going with minor glitches. We have some right in front of us, the Tata Group and the HDFC. The ones who lost some 6 months to really recover and get their act together. So I'm sure you would all agree that these lessons of the past offer us far more insights than what we had procured earlier. Let's now look at how global organizations, especially financial institutions, look at enterprise resilience and business continuity. Resilience to us at Bank of America is an elevated level of preparedness that incorporates proactive business-driven strategies for mitigating the risk and impact of a severe business disruption event in the overall design of operations and processes. Broadly speaking, the Enterprise Resilience Exercise Team, or the ERT as we call it, establishes the enterprise-wide resiliency and continuity exercise framework to strengthen companies' resilience and ability to respond to all these crises. The ERT must develop, maintain, and annually review the enterprise-wide resiliency and continuity exercise framework to enable practitioners through the exercise life cycle, including the initiating, design, perform, and evaluate phase of an exercise. This framework is applicable to all resiliency and continuity roles. In fact, we also conduct sudden or surprise reviews undertaken to help the resiliency framework preparedness. At Bank, we identify key stakeholders and partners well in advance who really have to step up into leadership roles as clearly defined in case of emergency. And the best action is taken at that point of time for the employees, for the customers, and also keeping in mind the vendors and the broader financial industry because we are all connected in the world. Our ERT plays the role of providing guidance to the leadership group and acts like a consultant. However, lines of business and enterprise control functions perform and evaluate the framework through the constant checks and reviews. Resiliency and continuity frameworks are effective only when LOBs and ECFs are involved right into the deep and not left when the situation really arises. The ERT at Bank of America decides and communicates, one, the enterprise response, which is to validate the effectiveness of plans and playbooks, to ensure teams understand their responsibility in case of emergency, rehearse response to incidents, and even make logs so that it is clearly understood and refreshed every time we have an exercise. Number two, major effect plans. All emergencies are not major, but we did come across COVID, which was really major. So to validate the effectiveness of plans and ensure teams under their responsibilities. The third and the most important we realized was the third party resilience. Validate the third party or rehearse third party failure processes. Rehearse the roles and responsibilities of the relevant control functions who need to take it over. Here, I would like to cite an example. When the pandemic broke out, we at the bank were very well positioned to immediately support the critical operations based on our resiliency and business continuity plan. However, on our third-party vendors, we were underprepared due to lack of technology equipment like laptops, internet connections with our actually vendors. However, with our Client Connects, we quickly arranged laptops and other equipment for our third-party vendors. But this was clearly an eye-opener for us. To what Mr. Mukundan said, technology is a key part for the business resiliency, and the underpreparedness can really keep us into trouble. Over the years, we at Bank have spent hundreds of hours to identify critical processes and strategic areas to finalize our resiliency operations. Let me now just give you a glimpse of conducting a business resiliency exercise. At the bank, all business resiliency exercises must contain objectives that validate the personnel are adequately prepared to respond and personal data is continuously updated. We don't want anybody new not to be included in case an event occurred. Number two, the plans, procedures, processes, or playbooks are accurate, sufficient, and updated and have clear owners in the businesses. Also, we have a system that lines up exercises well planned, and there are unplanned ones to really test our readiness of our systems. The exercise point of contact records and the response performance highlights, and also the failures within 35 days. This is further deep dived into, and gaps are finished within the next 30 days. For a robust business resiliency plan, employee safety and business continuity are of paramount importance. A BCM policy standard requirements and operating procedures established minimum guidelines designed to drive compliance with applicable laws, rules, regulations, and industry standards to maintain the availability of business functions in the way it can be done at that point of time. This enables Bank of America's frontline units, control functions, corporate audit, and third parties to achieve the earlier laid down strategic objectives. Coming to the most important, technology dependence and preparedness. Every bank is equally dependent on technology operations as it is today on capital. At Bank of America, Technology Service Restoral Plan framework addresses the strategic and tactical actions required to respond to tech failures rapidly and seamlessly. Technology restoral includes the process of restoring an application, supporting infrastructure, data, equipment repair, file recovery, resumption of service, etc. The BCP site at least needs to be 20 kilometers away from every main city as a mandatory requirement. As you all recollect, the pandemic hit first China and then the US. During this time, Bank of America's team in India proved our worth as offshoring to India suddenly shot up. We could significantly upscale our resources thanks to the efficient BCM process. Coming to the responsibility and accountability of the PCM program manager, there are key stakeholders. One is the enterprise area of coverage owner, which is responsible for all the compliance activities. Second is the corporate audit, responsible for providing independent assessment. Number three, and the most important, the board of directors, who is responsible for the oversight of the BCM program as well as enterprise risk committee. In addition, we have our resiliency and operation risk governance councils, which drive BCM compliance to provide strategic oversight and debate and dialogue to all key program stakeholders. I must admit that good companies will always need to continuously innovate even on the BCM and business resiliency. Finally, I would like to end with 5 key learnings for all of us after the COVID. 1, create a business matrix that can adopt best practices, adapt to disruptive change, and thrive in challenging situations. Number 2, acknowledge the importance of human capital and invest at all times in their upskilling and wellness. Number 3, invest in technology that leverages machine learning and AI. Number 4, establish an organization with a very strong and a sustainable ESG agenda. And finally, the 5th, participate in the national agenda by collaborating with government, regulators, and communities. Thank you. Over to you, Mr. Mukundan.
Thank you, Kaku. I think you started with a very fundamental bedrock of any organization which wants to sustain for long term. There is put purpose before everything else. Profits will follow. I think it's a very sound input to all of us. But I think you very clearly elaborated the way Bank of America has gone about the whole element of enterprise resilience through ERT teams. And 3 broad things you highlighted: enterprise response, major effect plan, but most importantly, I think the one which we all ignore is the third-party resilience. I think it's a good learning for us to go back. In most companies now, we have learned our weakest chain in the link is the weak part of our supply chain, may not be internal, maybe external to the company. And also you highlighted the importance of the technology backbone. And ultimately, you said the underpinning of all this has to be human capital, which is how much are we making them own up to the process, how prepared are they? All excellent inputs, and the framework itself was a very good learning for all of us. Thank you for this. I now request Mr. N. Venkatram, member of CI National Committee of MNCs and CEO Deloitte, to address us. Please, over to you, Venkat.
Thank you, Mr. Mukundan. Good morning, Mr. UK Sinha, Mr. Mistry, Ms. Nakate. I'm really happy that I have this opportunity to speak to this esteemed audience of peers today. A few decades ago, post-Cold War, the whole concept of VUCA emerged in America. The whole perception was that the world is volatile, it's uncertain, it's complex and ambiguous. And in this ambiguity, We all sought some sort of stability. And a lot of the governance that came out, a lot of the risk management processes that came out of what we looked at due to the transformational effect of the VUCA. However, I think that the pandemic and events of the last 2 years make VUCA seem a bit of an insufficient descriptor of what is really happening. Not only have we experienced the pandemic, we are also seeing the global tensions, whether in China, the geopolitics playing out, or in Ukraine, the emerging war scenarios that are being looked at by all corporates which are multinational. Climate change, we talked about climate change and sustainability. And of course, the increasing pervasive use of technology in the workplace. So it's quite possible that the Western world, and I emphasize Western world, and in particular America, have moved to what the American anthropologist James Cassio describes as the bunny world, which is a brittle, anxious, non-linear, and incomprehensible world. I'm not sure that we in India are in bunny yet, but certainly, and Kafu would support me on this, that the West is certainly a lot more anxious. And there is absolutely no doubt that the world is going non-linear. When we look at our plans, when we look at what we have to do longer term, it is certainly becoming a lot more non-linear. And this requires corporates to be much more agile, much more adaptable, and much more resilient. So therefore, the status quo has been challenged. And I would believe that the status quo has been challenged forever. And this is an inflection point for change. And this change is going to be a permanent change from what it is earlier. This is no longer a question of getting to normal again. I think the next normal or the new normal or however you would describe it, in my personal view, is more of an interim normal, because many of us really don't know beyond this interim period of 2 years, if and when the pandemic becomes an epidemic and we continue to live with it, if and when the war situation either escalates or de-escalates, we will all be reflecting, and if and when supply chains, national interest, and all the other complexities that go with it need to settle, there will be an interim normal before we think of what we believe is the next normal. So therefore, we can't ignore these. And as corporates would also need to engage with the larger members of society, the stakeholders, the government, and see what is expected of us. Keki did mention that there are new stakeholders who are emerging, the shareholder activism which is increasing. And yes, all this is part of the instability, the anxiousness, the fragility of the world in which we live. And so therefore, now more than any time else, stakeholders are expected to do the right things and to do them well. The expectation is on the range of issues that have already been discussed, be it the environmental and stakeholder issues, the need to protect your data, requiring strong governance mechanisms, and whichever way we look at it. I think that we must evolve from merely looking at some of these outcomes as chance outcomes to being a strategic priority for both boards and management alike. And therefore, I will dwell a little more on what business leaders should do, because a lot has been talked about the boards. And here I would say that business leaders need to adopt what I would call a mindset change. We need to move beyond the ability to look at yesterday to plan today and move ahead from today to the non-linear tomorrow, to plan what we need to do in this world where the situation has moved to the interim normal. So from what we see with our clients as well, I think that managements will in this period look in terms of how they can recapture revenue and look at new opportunities for top-line growth, customer experience, and profit margin. These will all involve judgments, and this is where the board would come in. And importantly, even managements would need to make judgments in terms of customer behavior and the like. There would also be changes to cost structures to increase profits and margins, largely driven, I would say, the decisions by the capacity to make future investment, by the changes in technology, and most importantly, and this is again a point which I think governance plays a role in, managing the long term versus the short term. Because the one thing the pandemic has done is brought a lot of our attention to quarter, and we again will have to think in terms of how we invest and how we think longer term and what the impacts would be. The whole issue of balancing resilience and profitability would come to the fore. And therefore, many of us would also be looking in terms of how we optimize our assets, our liabilities, and liquidity. We would look at how we curate our core assets, how do we strengthen our balance sheets, and how do we align our capital structures. Moving into investment mode, for example, would require balancing the expectations of liquidity and investment, and of course, overall profitability. There is absolutely no doubt from what we've heard this morning that digital transformation is the key to future growth, to reducing our costs, and making progress as insight-driven organizations. But as Kaku so rightly pointed out, we would also see what is the outcome of the pace of digital transformation to our customers, to vendors, to our people, in addition to what it means to the company. And this requires more articulation and deliberation. The future of work, another issue which is pointed out in terms of how we treat our talent, is of utmost importance. Future of work covers a range of areas. It covers the work itself, what we do, for example, today, whether it's hybrid and what period hybrid working would be there. Is it permanent, less permanent? What it means for diversity and inclusion, etc. The workforce and how do we define the workforce of the future? And what is their expectation? And what do we do to address that expectation? Do we also look in terms of gig workers and the like? Because all that has been talked about for a long period of time, but we have to really formalize what we have to do. And finally, the workplace. What is the workplace of the future? What are the expectations of talent? What is the expectation of a young India? We talk about the youthfulness of India, the fact that we have a young population. But what are we doing in terms of reskilling them? What are we doing in terms of training them? What is the future of education? How do we as organizations contribute so that we have this pipeline of resources available to us will become more and more important and critical to understand. Because this has brought about a change in social expectations as well. And no longer can we say that we are divorced from the societies in which we live or from the objectives that governments have. And therefore, integrating, as Keki so rightly pointed out, aligning with what the government does is also important for us to do. And in all this, outcomes are important, but I always stress upon the outcome of the outcomes that take place, because we have to think not only immediate outcomes, but longer term outcomes from those outcomes themselves. I'm therefore happy with the timing of this conference, and the topics would cover most of what we have discussed in the opening remarks this morning, and such as purpose, building trust, the talent and the workforce of the future, organization, culture, building resilience. We did not probably touch on innovation and growth, but I think that again will naturally follow as a consequence of what we do. And therefore, I would say and conclude that this is a period when I believe a new cycle in corporate history is taking place. And I think it is incumbent on each of us to see that when this history is written, the role that corporate governance, the role of the boards, embellishes the long-term success that we will enjoy. Leaders will emerge during crisis. This has historically been proven. And what is most interesting is these leaders will be trusted. So all the very best to all the leaders in this room, and I look forward to the deliberations for the day. Thank you.
Thank you, Venkat. As always, bringing out a different perspective, focusing on leaders rather than just on the boards, and also bringing this perspective that the world today is more brittle, more anxious, and it's non-linear world, and at times incomprehensible. But I think what you said at the core of everything is the leadership to have a mindset change, to be more adaptable, to be more tenacious, to be able to pick weak signals, and at the same time, think about non-linearity in their planning and execution so that they can execute well and serve the organizations well. Thank you so much for those words of exactly looking at future, which we are all seeing is very, very uncertain. We have been waiting for Mr. UK Sinha for his views and his thoughts. Right now, let me welcome Mr. UK Sinha to share his views on this important topic. Over to you, sir. You're on mute, sir. You need to unmute yourself.
Good morning, everybody. I'm grateful to the CII leadership team for giving me this opportunity. It's indeed a pleasure for me. I want to begin with a disclaimer that during my talk, I will be mentioning or naming a few companies in India and outside. But it is not that I have any particular view for or against those companies. I will be referring to them based on publicly available data regarding certain incidents and developments in these companies. And it should be taken that these are being highlighted by way of making a point rather than any personal view from my side on those companies. We are talking in this session about governance principles and business resilience and continuity. Corporate governance has been and will remain a very, very evolving subject. What was true or what were the guiding factors in 1998 are no longer the guiding factors for today. So for the sake of our discussion, I am looking at what are the signals that we are catching, what are the various winds those are blowing, maybe in the last 1 year or so, and what are the sources of those developments for those signals. I would like to categorize them in 3 categories. One is different surveys, studies, and reports. The second would be representations, letters, or court orders. And the third would be regulatory and government developments. Coming to the first one, I begin with the survey conducted by the firm Russell Reynolds in 2022. It's a recent survey, February 2022. And they had a survey of over 500 investors across the world. And the 4 or 5 important points which have come out of this survey are that the investors are becoming more assertive and more demanding. It's no longer a case that they come and vote for a particular resolution or abstain from a resolution. They are actively sending letters, demanding things, and they are becoming more and more assertive. No company can ignore them now. Second one is that there is more and more attention, higher attention to climate-related issues. The third one is about the effectiveness of the board, evaluation, and refreshment. And the fourth one is urgency regarding equity, diversity, and culture. If I go to another report, which is from McKinsey, they have said that there is a marked shift in a stakeholders' attitude, all the stakeholders' attitude towards ESG. For example, there has been a 130% per annum flow, the growth, per annum growth in flows to sustainable funds between 2018 and 2020. So year after year, 130% growth. And the impact of this for any company is very clear that if funds are going there, then what are the type of demands which will be made in future on the companies about their performance and about their actions. Now, ESG funds constitute a massive $2.7 trillion. So you can, and in 1 year, $130 billion came last year in ESG funds. Fidelity conducted a survey of millennials, and we know what we mean by millennials, but I would like to highlight here that in our discussion today, millennials also mean people who may be young, but they have surplus money. They have investable money. And in fact, they are making their presence felt more and more in the investment arena. According to Fidelity survey, 74% of the millennials call themselves as philanthropists. So they regard that philanthropy is very important and very high in their agenda. And the same percentage for baby boomers, that is people born prior to 1964, was 35%. So more than double than the baby boomers are the demand and expectations from the millennials, the young investors. The young investors also have indicated that they will like to work in companies which are following high social governance principles. So 87% of them want to work in those companies who follow social responsibility. 65% of them want to buy products from companies which score very high on ESG. And 43% of them want to invest in companies which are scoring high on ESG. This ratio of 43% compares with 12% for baby boomers. So on all these parameters, whether they want to work in these companies, they want to invest in these companies, they want to buy products in these companies, the signal is markedly clear that the shift has taken in a manner which is irreversible, and every company has to take these shifts into mind. Let me now come to the report from, and this report came about 4 days back, the Interparliamentary Committee on Climate, the UN IPCC report. Yeah, as you know, it is the 6th report, and the 6th report was in 3 parts. One part came in June last year, another part came in August last year, and the last one has come in April this year. It says very clearly that there is a very strong danger that the Paris goals of 1.5 degrees centigrade increase in global temperature from pre-industrial times is very difficult to achieve, because we have already had an increase of 1.1 degrees Celsius. So on the point of having 1.5 degree by the end of this century, 1.1 degree is already there. And their estimate is that in 2021, the emissions actually increased compared to 2020 by 6%. So instead of coming down, the emissions increased. And their projection is that in 2022, the emissions are going to rise further. So according to their assessment, all the countries put together, all the corporations put together will have to drastically improve their performance and reduce the emissions level by 43% by 2030 if we want to achieve the Paris goals. And they are also saying, very important for me to point out here, that besides the climate related thing which the IPCC has said, for the first time, the IPCC report is also talking about, has a separate chapter on social issues and societal issues. And they have highlighted that companies have to focus on this. People, individuals have to make lifestyle changes, and whole society, the societies will have to make lifestyle changes if we want to reach those goals. I also want to highlight here that when we talk of ESG, there is always an issue regarding how to measure it. What are the right measures? So fortunately, in the last 2 years, there has been significant development about having a globally acceptable measurement system on ESG. The Integrated Reporting Council merged with IASB, International Accounting Standards Board, and they formed a new institution called ISSB, which is which is working under the umbrella of an organization called Value Reporting Foundation. The good thing is that they have got full support of IFRS trustees, and with the support of the IFRS trustees, organizations like TCFD and others have also come within the same umbrella. MOUs have been signed, and last week, the Value Reporting Foundation has come out with 2 draft guidelines, 2 draft standards on reporting, because we are aware that there has been an issue in the last 3-4 years, ever since ESG has become a very important subject, that how do we measure it? And there have been complaints about wrong reporting. There have been a complaint about greenwashing and things like that. And that greenwashing complaint has been both against the companies, corporates, but also against the investors, because some of the investors who had been claiming that they were working very highly in a very serious way, they were themselves criticized that some of their investments do not qualify. So the issue was measurement. And I like to flag, and I'm aware that Mr. Venkatram is here and he will perhaps endorse it, that so far as financial accounting is concerned globally, it has taken decades for financial accounting to become standardized. And even today, we don't have one uniform accounting standards. The point I'm trying to make here is that in sustainability reporting, there is a much quicker movement, much faster movement than anybody could have imagined. And already 2 standards are out. It came last week. Coming to the second bucket of representations, court orders, and letters, Mr. Mistry has rightly pointed about what happened in ExxonMobil and how they had to accept 3 new nominees and their own nominees were defeated. And that was on the effort, based on the efforts of one particular investor having 0.02% in that company. And they have also forced, the investors have also forced ExxonMobil to vastly accelerate their carbon reduction targets. So one was the new members which were appointed, but they had also had to redo and rework on their carbon reduction targets. In case of Royal Dutch Shell, we had this incident in 2021 May, that a court in Netherlands passed an order that they are not satisfied with the emission reduction targets of the company, and they insisted that those targets have to be vastly reduced. And interestingly, a civil court invoked the principles of human rights. So that this emission beyond a certain level is a violation of human rights. It affects the whole community and things like that. So human rights violations have been brought into this for the first time, as far as I can recall. I'll also like to bring a very interesting example, which happened again a few days ago. Amazon, as we know, has been resisting that there cannot be unions, employee unions in Amazon. Last week, in Atlanta, the employees of Amazon were able to form a union, and the case of management was that they follow a system of what is called a chain of employees, that everybody is not an employee. You are an employee and you employ another employee. You recruit another employee. So the second employee is not an employee of Amazon, but it is an employee's employees and things like that. The chain system they followed. And in the past, when they went for their voting and all, they were all defeated. Obviously, the management didn't encourage them or even facilitate their voting. So they had their meetings in coffee shops or at bus stands and all that. But finally, they have been able to form a union. And why I'm highlighting it is that I'm going to mention this in the later half of my talk, that how human resources issues, HR issues for the companies are going to be the most important thing as in the next 1 or 2 years. While environmental related issues have been guiding us or have been a matter of concern for us for the last 5 years or so, 2022 and maybe next year also, HR issues are going to be the most important issues. We know that BlackRock has demanded that their expectation is that over a period of time, there has to be 30% diversity, not only in boards of corporations, but also in employees. So they have to report on employees' compensation. If you recall, 5 years back, in all the AGMs in Europe or in America, the most important thing highlighted was the pay ratio. So what is the ratio of the pay of the chief executive officer versus the median pay of the employees? Now the dimension is changing. Now people are asking, what is the type of diversity you are having? And diversity doesn't mean or remain confined only to gender diversity. racial and other orientations, those are being monitored, not only at the level of board, but also at senior leadership. So that is going to be a very important ask from the investors, and corporations will be forced to think in these areas. Also, there is a demand in many corporate boards and in AGMs that the compensation of the senior executives should be linked to the performance of net zero targets. There are instances where the compensations have been challenged by the shareholders in the AGMs, that what portion of his compensation is linked to achieving the targets on climate, the targets on sustainability. And I came across a report that Deloitte has come out with a survey that in FTSE 100 companies in England, 28 companies have already done it. That is, 28 companies out of top 100 have already aligned the chief executives and other senior management's pay with their commitment to the environmental goals and net zero targets. And according to this report, 24 more are likely to do it in 2022. So that was 28 was in 2021. So 42 out of 100 companies will have this. So you can imagine how serious this demand and this ask is from the companies. Companies who discharge water, they are being forced to report on their tailing dams and how robust these are. And now the trend has become, it is now an ask which is being enforced, that companies have to have a third party assessment of the safety and health of their tailing dams and put it in public domain. So that is the new development that I'm noticing in the last 1 year or last 2 years. Coming to the regulatory and government developments, it was rightly mentioned that SEBI has come out with a new set of guidelines called BRSR, Business Responsibility and Sustainability Reporting. How, and it is applicable for top 1,000 companies. How it is different from the earlier BRR is that BRR was completely descriptive, whereas BRSR is very, very quantitative. Per unit of production, how much power you are using, how much CO2, how much NO2 or NOx, how much SOx the company is releasing in the atmosphere. Per unit of production, how much water is being discharged. Are you going to be a net zero water discharge company or not, and things like that. So my sense is, and having worked in the government and having worked in the regulatory system, my guess is that this requirement, which has been introduced as a voluntary method first, will become now mandatory. What is now mandatory and is confined only to reporting will also, in near future, according to my understanding, it will also lead to companies being held accountable. First is the idea of capturing the data, the reporting part of it. And the way regulations develop in India and even outside India, but more so in our country, I won't be surprised that 2 years from now, companies will be made accountable to their discharge and other things. In any case, once you have a reporting on a very, very quantitative methods, it becomes very easy for analysts to compare your company and my company. So for the investors, this will be very easy to know that how good or bad a particular company is doing. But I'm going a step further and making a guess that in due course, the regulator itself might try to enforce that these things are followed very, very strictly. US SEC, we have it has rightly been mentioned that they have come out with this. In the EU, the European Commission has come out with a set of guidelines and new rules about pollution and other matters. Now this has gone to the European Parliament, and this has to be ratified by all the member nations. But the expectation is that during this year end, by end of this year, the EU EFRAG will become applicable. I'll also now come to a slightly different aspect about regulatory action. You remember last 3 or 4 years back, for the first time in this country, we started seeing action against auditors in a big way. I'm not talking of isolated examples. So this is the regulator's way of forcing a rethink that if you are a gatekeeper of corporate governance, you are also held accountable. Act has been changed. Now you know that again an amendment has taken place where in the Institute of Chartered Accountant Disciplinary Committee, there will be non-accountants and non-auditors and things like that. So the message is very clear. My main point here is that now we are seeing instances of regulatory action against independent directors. In the context of real estate companies, it so happened that about 3 years back, the Supreme Court came out with the directions. Now, we have seen a recent example of independent director of a company. His demat account has been frozen by SEBI because that company had not been very transparent in releasing data about the voting in the AGM. So just because the voting data had not been released, they have gone to the extent of freezing the personal accounts of the independent directors. What it means for all company is that there will be more and more pushback from the directors rather than blindly accepting whatever is the put up before them in the board. So I think have I overshot my time? Do I have another 3-4 minutes?
Because
Because
okay.
Yes, please. Yes, please.
Yeah, I'll finish in next 3 minutes because I'm saying that we have exceeded our time. So the main point I would like to make here is that what is the culture of the organization is the most important thing. If you get a whistleblower complaint, do you try to sit over it, or you try to cover it up, or you take it as a very genuine input based on which action has to be taken? So the culture is most important. And we have seen examples of companies like Wells Fargo or Kobe Steel or Uber who have suffered very, very badly on account of bad culture. Transparency is again very, very important. One question generally asked is there a friction, or is there necessarily a friction between independent director and the management? And should the independent directors be trusting the management? My feeling is that this question is not the right question. The right question is the management providing all the relevant data and information at the right time in the right manner so that they can take an informed decision? So we have to go out of this mindset that there has to be a trust. There has to be a constructive respect for each other. But there will be independent directors, even auditors and independent directors and others will be within their rights to ask questions. And those questions can at times, in some companies, not in all companies, can be problematic. Crisis management is another area about which companies have to be very, very careful. That and my recommendation to some companies has been that you do a mock exercise about crisis management in your board. For example, imagine that you are sitting in the board and today some news has come about your CFO being involved in some undesirable activity. What do you do at that particular moment? What do you do? And do you have the system in place to handle such situations? Cybersecurity is another such area. My last point is that going forward, matters concerning employees whether there is diversity, whether they are being trained properly, whether they are happy, whether they are being promoted in the right manner. All those things, the HR matters are going to be the most significant matters for any company to succeed. What we need to realize is that winners in the next 1 or 2 years will be those companies which have some differentiated story to tell. Your production, your performance, financial performance, all that is fine. But the company has to have some differentiated story to tell when they are being compared with others in their group. I'll stop here and I thank you once again for giving me this opportunity. Thank you.
Thank you, Mr. Yukesena, for sparing your valuable time. I think your central theme at the end of it has been that companies have to be more responsible. They must become trust-based organizations and build a culture of transparency and openness and respect for all the inputs that they're getting so that they can move forward towards better governance standards. And it's a journey, as you mentioned, it is not a destination. It's an evolving journey. Thank you for those words and giving us those valuable inputs. I also want to thank Mr. Mistry, Ms. Nagte, Mr. Venkatraman for your perspectives on very important subject of corporate governance. We are grateful to all our speakers who will be deliberating on various issues through the 2 days of the summit. We are thankful to all our distinguished guests and delegates who have spared their valuable time for attending the summit. My sincere apologies for overshooting this session. Hopefully, we will catch up in the next subsequent session. Over to you, Vikas.
Thank you very much. We have completely run out of time. Mr. Sinha, we could have gone on and on, but we would seek an opportunity to have you in another session. So thank you very much, all, Mr. Mistry, Mr. Venkatram, Kaku, and of course, Mr. Mukundan for taking time out at this early mornings. Thank you all, and we are having the next session at 11:15 on ESG and related areas. So please do join the next session in a couple of minutes. We'll be starting. So thank you all very much for your time. Thank you.
Thank you. Thank you, Mr. Sinha. Thank you, Mr. Mukundan. Thank you, Venkat.
Thank you.